Today, we're tackling a really big question, one that every single person who saves money has to face. With all the options out there, why do stocks always seem to be
Okay.
the main event in the world of investing? Well, let's dive in and find out.
Right? This is the starting line. You've worked hard, you've saved up some money. Now what? How do you actually make that money start working for you? With so many choices, that very first decision can feel, well, pretty huge.
For decades, through all the market craziness, the booms, the busts, one answer just keeps rising to the top: stocks. But why? What gives them this special edge? That's exactly what we're going to unpack right now.
So, before we just hand the crown to stocks, let's get to know the competition a little bit. It's a much bigger world than just stocks versus your savings account. Think of it like a lineup of different players, and each one has its own special moves, its own strengths and weaknesses.
Okay, so here's a quick tour of the big six. First up, you've got cash. It's safe, sure, but inflation is constantly nibbling away at its value. Then you have bonds. They're basically you loaning money for interest. They're steadier, but not exactly exciting. Then you get into the wilder stuff, like currencies and commodities. Think gold. These can be super speculative. And of course, there's real estate. It's a fantastic asset, but you can't just sell your kitchen on a Tuesday afternoon if you need cash, right? Every single one has its role, but one has, historically, just blown the others away. And this chart, well, it pretty much tells the whole story. Look, while every asset class has its good years and bad years, the trend over the long haul is crystal clear. See that line for stocks? It just keeps climbing higher, outperforming things like bonds, commodities, and definitely cash. It's that long-term growth, even with all the bumps along the way, that is the whole reason we're talking about this today. So, seeing that chart makes you wonder, right? What's the secret sauce here? What is actually powering that incredible long-term climb? Well, it really just boils down to three core strengths that other asset classes, they just can't seem to match. So the first pillar is this amazing, almost magical force called compounding. Think about it like this. If you earn a 10% return on $100, you get $10. Cool. But the next year, you're earning 10% on 110. It's like a snowball rolling downhill. Your earnings start making their own earnings. And over decades, that little effect creates wealth in a way that almost nothing else can. The second strength is just how practical they are. You can literally buy a tiny piece of the most innovative companies in the world from your phone in seconds. That's what we call liquidity, the power to turn your investment back into cash really fast. You just can't do that with a building or a famous painting. And finally, and this is so important, stocks aren't just numbers flashing on a screen. They represent actual ownership in real businesses. Companies that are out there innovating, creating stuff, growing their profits, and adapting. So when you own stocks, you're not just betting, you're participating in the engine of economic growth itself. Okay, so stocks are powerful, they're easy to get into, and they're tied to real growth. Sounds perfect, right? But, and this is a really big but, just because they're easy to buy doesn't mean it's easy to win. And honestly, this is where a lot of people get tripped up. This quote absolutely nails it. The fact that it's so easy to trade can actually be a trap. It tempts us to make decisions based on emotion or some random hype we see online. It's one thing to click buy, but it's a whole other thing to consistently make a smart decision. To be successful, you still got to do your homework. That means really understanding what a company does, checking out its financial health, and paying attention to what's happening in the broader market. Your decisions have to be based on data and a clear plan, not just a gut feeling or what's trending on social media. And part of that homework is knowing what game you're playing. For almost all of us, that's the public markets, like the New York Stock Exchange. It's a regulated space where everything is out in the open. That's totally different from the private markets, which are usually for the big shot institutions. The key is to know the rules and stick to the arena you're actually equipped for. All right, now for a really critical piece of the puzzle. Even though stocks are kind of like the star quarterback of your portfolio, you can't win a championship with just one player. Putting 100% of your money into any single thing, even stocks, is just plain reckless. A truly smart portfolio uses stocks as its main engine for growth. You can see here they make up 60%. But look at the other players on the team. You've got bonds to add stability, real estate and commodities to protect against inflation, and some cash on the sidelines for flexibility. It's not about betting it all on one horse, it's about building a solid team that can handle whatever the market throws at it. So let's wrap this all up.
If you only remember 3 things from all this, let it be these. Number 1, history shows stocks are the most powerful engine for building wealth over the long term. Period. Number 2, that power only gets unlocked with a good strategy and some discipline. This is not a get-rich-quick scheme. And 3, smart investing means using stocks as the core of a diversified team, staying in the loop, and always thinking long-term. So, in a world filled with endless choices, stocks are the benchmark for a reason. They offer this incredible mix of growth, access, and a real stake in the economy. So really, the question isn't if you should invest, but how you're going to use that power for your own future. So what's your next step going to be?
Okay, I'm sorry, but I think your next stop has to be to answer the quiz, okay? So let me go back to our thing here, get the quiz link should be here, okay? And then post it on our, I think that we need now to leave I guess so. Do I need to leave the thing? Oh, yes, I think so. Meeting. No, I think I need to leave this and then come back later. So I need to go here to our chat box and let's add the link here and check. Can you, Zach, can you confirm you got it? Oh, it's probably left right now.
Yes, I got it.
You got it? Okay,
yes.
Yes. Okay, so let us know when you finished.
All right.
Okay, and view. I've got. Okay.
All right, I finished it.
Okay, very good.
Yes.
So we can
Yes,
continue now. Okay, so the video was very interesting and right to the point. But of course, we need to consider whether the stocks are the only game in town, and also which town shall we look at? Shall we look New York, London, Tokyo, whatever? So in fact, we have to look. So initially we look at the assets just in the US, but if you want now to look at stocks across geographies, you can also look at for them here. You have here, for instance, in terms of geographies, you have that, for instance, South Africa seems to to have done well in the recent past. So this is one way of looking at it. If you want to look at in terms of currencies, then you can look as well in terms of currencies and see which one has done well. We'll come back to that. Of course, we can look also at sectors, which sectors have been doing better. For instance, for the last period, the technology is still on average, but not so much recently. If you look at who is doing well right now, who is doing better right now is energy, basic materials, and so on. So you have here the way of looking at it, not just from stocks in general, so for the whole market, but looking at on a sector basis. And of course, most important, you can also go in more detail and look at industries, instead of sectors. And again, if you want to who is doing better right now, it's oil and gas exploration, oil. So when you can obviously understand why oil is doing so well. But if you look at the average, their average return is not so great. In fact, the median return of oil and gas exploration is negative. So again, very cyclical, as I told you, because these are sectors related to commodities. And of course, they are very cyclical. But in the recent past, they have done quite well. So you have to. And finally, of course, and most importantly, I would say, you have to look at countries. So you can you can look at countries in local currency. For instance, we have here local currency, and see which countries have been doing better in the recent past. For instance, you have here Sri Lanka, South Africa, Euromed. Euromed is the group of countries in Southern Europe, including Spain, Portugal, Italy, Greece, and Slovenia. Taiwan is doing well. The US is doing well, but if you look, for instance, the most recent quarter, the one who's doing better is South Korea, Taiwan, and so on. And if you're looking for the US, it's not doing very well. It's actually having a slightly negative return in the last quarter, you see. So, but overall, the US has been traditionally a good market with a return of about 5%. So it has been a good market. Of course, another important issue is that when you look at it in a common currency, like using our own index, the FEI, if you look at them in the currency, in the same currency, probably you get a different ranking of countries. Again, you see the US is not doing as well as Germany, for instance, or even the Benelux of France, the US is doing worse than that, even on average. So, and if you look in terms of the last quarter, again, you have big differences. For instance, Norway comes top because the krona has been appreciating. And the US comes still negative in international currency. So again, if you look at comparing countries, you should compare the countries in one common currency. I mean, a lot of people are used to comparing countries using the dollar, but the dollar is the currency of one of the major markets. So our own currency, the FEI, which is an average of 8 currencies, including the dollar, euro, and the Japanese yen, is a better measure than using the dollar. But no problem using the dollar or the pound or your own country's currency. So there's no problem with that. But the more independent and less biased approach is using a composite currency like the FEI, which gives you the possibility. Okay, this is an important decision that it's not just enough to say, okay, stocks are great, but where are stocks great? Okay, so is it on my country? Is it in your country? Is it, shall I invest in several countries? So I need to consider where they are doing well in what kind of countries, sectors, industries, and so on. But not just that. Of course, we should not, as we was said in the video, we should not put all our eggs into a single basket, right? So we should spread the risk by looking at various, and we have it in our platform a way of looking at that by diversifying across asset classes here, or geography, all the categories you have there. We can do the analysis diversification. How you do diversification analysis here? Gosh, this thing is again on top of things. Okay, so probably it's not updated here. Okay, sometimes we need to change the data if it's not hasn't been updated today. So if I were to leave all the asset categories right here, and using these limits, a minimum of 2% and a maximum weight of 20%, I would invest actually less in stocks than I would invest in cash and commodities. This would be the optimal allocation with the, based on this on a medium return plus this spread. So the minimum return. And if I were going to use that, of course, stocks would not look very great. So, and this is using a methodology that we'll talk later, but it's very common. It's based on the so-called modern portfolio theory. So it's based on optimization, based on the diversification or risk. So if you're going to do that, that would do this mix. But of course, we probably, if we want to do stocks, we want to have a more stringent rate of return. And if I increase this, that will change the allocation here. And moreover, if I, for instance, I want to have 2% above the median. So if I want a return of 2% above the median, then the weighting here would be changed. And if I, for instance, I don't want a minimum or don't want a maximum here. Let's say if I put, I don't put any restraints here. If I put one single asset could take all the stock, then out here, you see the dollar would be not, and the real estate would be left out. Stocks would get 42%. And if I increase my return requirements, like for instance, 3% above the median, okay, then stocks would be 63%, and commodities about 28%. So basically, I would invest just in, keep a bit of cash, a bit of bonds, and some commodities, and the rest will be put into stock. So this allocation decision, it's very important from the point of view of diversification, which is a topic that we'll discuss later on, but gives you an idea of the tools that we have here. And of course, in fact, I can't see what would be the maximum return requirement that I would require to have 100% in stocks. So if I want to have 100% in stocks, I must require a rate of return at least 4% above the median return. And the median return, we can look at it here in the market section. These are quarterly returns, by the way. So if I go looking at the median return, it will be, say, 1 or 2%. I would have to be 4% above that, which means I would require a quarterly rate of return of about 5 or 6%, which is quite substantial, given that the market overall has a rate of return of about between 8 and 12%. So this is again a tool that lets you decide what kind of allocation you're going to make in relation to stocks. Of course, from now on, we'll assume that whatever allocation you do, the money that you put in stocks, your full money, it's your 100%, and we will discuss on that basis. Okay, so much about how we should go around the, oh dear, I think we are we need to rush a little bit. So let's go to the last topic of today's session, which is what are the reasonable expectations that we can get into the market. And let's go to and watch our video first. As usual, where is it? Investment quiz. Okay, let's see how to set. Okay, here it is. Okay, let me just check if the sound is on.
Which quick,
Okay,
but today
I think it's
we're going to
solved
focus
now.
on what's actually real. We're going to figure out how to set investment goals that you can actually hit. Goals based on hard data, not just, crossing your fingers and hoping for the best. I mean, who isn't chasing those 1,000% returns, right? It's so easy to see the appeal. You see these headlines about some stock just exploding overnight, and you can't help but think, man, why not me? That dream of 1,000% return, it's powerful. And let's be honest, for a lot of us, that's what gets us interested in investing in the first place. And just to be super clear, this isn't some complete fantasy. These are real results we're looking at. Gains of over 2,000%, 900%. These things actually happen. These are the stocks that make legends, right? But, and this is a huge but, there's a massive difference between catching lightning in a bottle and building a solid, reliable investment strategy. And this right here brings us to what we can call the 1,000% delusion. It's this belief that you should be aiming for these monster returns with every single stock you pick. It's such a common trap for new investors, and as we're about to find out, it can be a really, really misleading and dangerous one. There's this quote that really just gets to the heart of all this. It says, there's a brutal honesty in the stock market. It doesn't care what you want, only what you're willing to risk. Think about that. The market doesn't care about our dreams or our hopes. It just operates on cold, hard data and reality. So let's get real with it. Okay, so if the market is so brutally honest, what is the actual truth it's telling us? What's the real story here? Well, it's time to separate all that hype from the hard data and see what the market actually delivers, on average. And here it is. Honestly, this might be the single most important number for setting your expectations. Historically, the broad stock market, it's delivered an average annual return somewhere between 6 and 10%. Just let that sink in for a second. Not 1,000%, not even 100. 6 to 10%. That is our baseline for reality. But here's the thing. Average is a really tricky word. It definitely doesn't mean you get a nice, smooth ride year after year. Oh no. The journey is anything but smooth. It's more like a roller coaster with incredible highs and some really stomach-turning lows, especially when you're looking at the short term. So how volatile are we talking? Well, get this. In just one quarter, the Turkish market soared over 51%. That's incredible. But on the flip side, in another quarter, the Sri Lankan market absolutely plummeted more than 34%. These are massive, massive swings that just go to show how unpredictable things can be from one month to the next. Okay, so remember those huge, crazy gains we saw at the beginning? The ones that get everyone so excited? Well, they're the product of what we call outliers. These are the stocks living way out on the extreme ends of the performance spectrum, and it is absolutely crucial that we understand what they really are. So what's an outlier? Well, to put it simply, it's a stock that performs dramatically differently from everything else in the market. We're talking about the top 1% of winners, or, the bottom 1% of losers. By their very definition, they are the exceptions. And let me tell you, building your entire strategy around chasing exceptions, that is a very, very risky game. So, okay, why is chasing these things such a losing strategy? Well, the data is crystal clear on this. For one, these outlier winners, they're usually these tiny, super risky, unrated microcap stocks. Your stable, big-name, blue-chip companies, they almost never show up on that list. And here's the real kicker. The data shows that the big losers are actually more frequent than the big winners. It's a total lottery, and the odds are not in your favor. So what's the final, brutal verdict from the data? Well, if you built a strategy purely on chasing these high-flying outliers, your average expected return, it wouldn't be 1,000% or 100% or even 10%. It would be negative 5.3%. That's right, you'd be expected to lose money. And that's because the risk of picking a catastrophic loser is so much higher that it just drags the entire average way, way down into the red. All right, so if chasing outliers is a total losing game, what's the real secret to building wealth? What actually works? Well, it's a concept that's way less flashy, way less exciting, but as we're about to see, it is infinitely more powerful. The real secret is something called compounding, and it's like magic. It's the process of earning returns and then earning returns on top of those returns. The classic example, of course, is Warren Buffett. The guy didn't get rich chasing these wild, flashy gains. He did it by averaging a mere 20% per year. The key? He did it consistently for over 60 years. And this is where you can really see the true power of that consistency over a long, long time. Check this out. $1 invested at the market average of 10% for 60 years, it grows to about 386 bucks. Not bad, right? But at Buffett's 20%, that exact same dollar becomes, wait for it, nearly $55,000. That is the superpower of compounding. It's not a gimmick, it's not a trick, it's just pure math and time doing their thing. But hold on, here's the big reality check. Being the next Warren Buffett, yeah, it's incredibly, unbelievably hard. I mean, look at this. This chart looks at professional fund managers, people who do this for a living, over 30 years. Nearly 60% of their funds didn't even survive that long. And out of the ones that did survive, only a tiny 10% managed to actually beat the simple S&P 500 average. Clearly, consistently beating the market is the rare exception, not the rule. So, where does all of this data leave us? What are we supposed to do with all this information? Well, it points us toward a much smarter, more grounded strategy. It's time to stop shooting for the moon with every single pick and instead start to aim smart. And really, it all boils down to a pretty simple 3-step approach. Step 1, know the market. Just anchor your expectations in that historical 6 to 10% average. That's your reality. Step 2, use data, not hype. Do the analysis, look at the real numbers before you start fantasizing about unrealistic returns. And finally, step 3, and this is the most important one, let time work for you. You have to embrace the slow, steady, but truly massive power of compounding. So I'm going to leave you with a final question, something to really think about. When you look at your own investments, what are you doing? Are you just gambling, hoping to hit a jackpot? Or are you patiently building real, lasting wealth? Are you out there chasing lightning in a bottle, or are you planting a tree? The data we've looked at today is crystal clear on which one is more likely to provide you with some nice shade for years and years to come.
Okay, I hope you have enjoyed this short video. Let's now look at a bit deeper into this question of what should be our expectations by again looking at Buffett himself. As was mentioned in the video, so there is a huge difference between earning 10%, which is grossly speaking the average of the market, and earning 20% over a very long period of time. And in fact, we have worked it out through a new measure of a new measure that we call the market beating multiplier, and that allows us to monitor progress or success in investment by knowing how much a manager gets above the market. And if the multiplier, of course, is above 1, if it beats the market. If it's below 1, it is underperforms the market. And we have added to our folder a short paper that I posted some time ago in one of the academic databases, where you can look at that, and I have posted it into our folder. So if we go back here, you can actually look at that. But before doing that, let's just go and look a little bit closer to this idea of getting this fantastic return by using the Interactive Brokers platform and our own platform. Remember that when you were looking at the Interactive Brokers platform, we had I'm not sure if I'm the right page, not here. Okay, nice mosaic. Okay, you are looking at the daily returns here. When you look at the big movers on a day, you see that you have here a company who increased the price by 24%, another one by 17%. Here you have another one that lost 22%, and another one who's losing 21%, another one 15%. And if you come every day to this to check on this, you find this type of return. So plus 20, minus 20, or around there. So can you imagine what it would be like if you could forecast the ones that go up 20% and the ones that go down 20% on a daily basis? Then you become rich beyond any reasonable assumption. And but of course you can only do that if you could travel in time and go back to go forward to tomorrow, sorry, to go back to the day after tomorrow and check the ones that will increase 20% tomorrow, and then you could anticipate your purchase on that, and then you would become rich quickly. But there is no way you can do that because you can't travel through time. So unfortunately, so we have to be more realistic about what we can achieve. But we can also, if you think that a big change on a daily basis, and it's certainly a big change on a daily basis. Let's look what it looks like in say a 1 year basis. And here we go to our platform again, and I think we are here. Okay, so in the US, let's look at the US, for instance, and let's see what kind of changes we can expect in the US. I mean, you can do this for any country you like. Let's just look for the US, and we just need to set up the date here. Select all the industries and select the date. Okay, so it's 16 March. Let's go 1 year back to this. Okay. To the 16th of, it's actually a weekend. Let's go to the 17th. And I think we have everything we need. And now let's put here, I think there are about 5,200 stocks. So let's look at the 502,000 stocks to see what we get. And now we are screening the entire US market for the last year. So between yesterday and the day and 1 year ago, on the same date. It takes a little bit of time because there's 5,200 companies, but if you were using a smaller country with, say, 500 stocks, it would be much faster, of course. But it takes just a few seconds more. Just to illustrate the kind of odds you are betting against when you try to do to time the market, which is one of the first illusions in investment, is that we can actually time the market and get these fantastic returns. Oops. What's happening here? I think we get a mistake for some reason. Not finished yet. Okay, this is one approach that's, if we look at what the market does, and we can see that the reason why we can't beat it is that, let's say the result is, I'm anticipating, let's say that the result comes with the plus 1,500% return and minus 99.5%. Actually, as you see, you can't lose more than 100%. So if you lose 99.5%, it's almost the same as losing your entire capital. The problem with these huge numbers that you find every year or every period is that the probability of having if you were selecting your stocks by throwing a dart into the list of stocks, your probability would be 1 divided by 5,000 or 5,200 if they are 5,200. Okay. But the probability of getting the big winner, it would be that value. But again, the problem is that the probability of getting the big loser is exactly the same. So it would be exactly the same, 1/5. So it's quite a remarkable risk to try to bet on the big winner and get the big loser. And I think this is finished, so we can now look at the results. We just need to, list them by. Okay, you see, actually the big loser last year was this company called Jibo. I don't know what is Jibo Holdings Limited, which would lost 99.94%. So basically 100%. Okay, and if you want to know the big winner, you have this company here who actually won, increased 8,000%, and the next one 4,000%, much more than the 1,500 that I had here. So you see, and if you do this for a different period or for a different year, the results will not be very different from what you have here. So what happens is that every year in the market, there is a few companies that have appreciate by more than 1,000%, but there are also again a similar number of companies that will lose 99% of their value. So, and if you are betting, and if you're betting with, then the chances are the same. The chances of you losing your money and getting one of the big winners are exactly the same, and of course are very small, because if you divide one by 5,200, you see that they are very small, the chances that you get those. So this is the basic about the trying to pick the winners or losers. So some economists came up with the idea that in fact you should not try this. You should be content with trying to beat the market. And there is a Nobel winner guy called Sharpe that probably all of you have heard about, that came up with the idea that in fact, if you have just two investors, one buying the entire market, and the other one, or the other investors buying if you have two groups of investors, one buying the entire market and the other one buying the rest of the market, they would have exactly the same return. But because the one would be trying to find the winners, so he would try to to beat the market to find the winners, he would have to run expenses, and because he would have costs, then he would underperform the first group. Okay, so this is actually a bit of a fallacy on this reasoning, because you don't have just two groups of investors. You actually have three groups of investors, and these three groups of investors, this is group one, the one who simply buys every stock in the market. And what do I have here? Okay, I think we can actually forget about this. Where are we? Okay, so we have this guy who buys the entire market, and then we have these guys that want to beat the market. Okay, so these guys, you have so-called that you have the losers and the winners. Because you have three groups, not just three, you have a group of losers and a group of winners, then it is possible for the winners to actually beat the market. So, and of course, then the winners will beat the market as long as there are losers in the market. And of course, who are the losers in this for this strategy? The losers, as we saw in that video, are all those fund managers that don't survive, or those 90% of fund managers that cannot beat the market. So they are the losers, and they are necessary. They are needed to actually to allow the winners to beat the market. Otherwise, the winners would not be able to beat the market. And of course, to those losers, you can also add, day traders and the high frequency traders and so on, who actually are in the market for a quick buck, but their role basically is to allow those clever guys that can be the winners to beat the market. And so that's an important thing. And then if you want to understand that, let's look at the Warren Buffett's experience again. And I think it was in the text that the market made 10%. He made about 19%. And this 90% over a period of 60 years managed to give that huge increase in their return compared to the market. But so because of this arithmetic here, it became very popular nowadays, especially with the ETFs, the so-called market beating ETFs, or market tracking ETFs, for people to believe that they are actually buying the market when they buy an ETF. So that is actually an illusion, because if you are trying to beat the market, you need to measure the return of the market. For instance, here we have the return of the market. You see, the return of the market for this period was, because we have all stocks here, would be 25.68%. And the SPY, who is supposed to be the S&P 500 ETF, only have a return on 17.96%. So the SPY in this particular year couldn't beat the market. It doesn't mean that some other years the SPY will be able to beat the market. In fact, we have some data that we can show you tomorrow to illustrate that point, where the circumstances where a given ETF, if it's well structured, can beat the market. And we have the statistics for all the markets that we follow. We monitor that, so you can let you know tomorrow how it is the position of every market. But the important message to retain here is actually then to understand that okay, I want to beat the market, then I cannot buy the entire market. I need to buy a sample of that market. And the thing is that how many stocks do I need to have a sample that is really a true replication of the entire market? And that can be worked out. We have worked out, and we'll show you the numbers as well. And in the case of the US, is a number of stocks which is generally above the 500 stocks of the stock index. And this varies, of course, from country to country. And so what we can see is that some ETFs, which are usually much smaller than that number of stocks, may or may not beat the market. But the objective of beating the market is quite a reasonable one. And that's why we think that any good manager should be assessed against the market. But the market measured either through ETFs or for a true sample of the entire market. Here we can calculate the return for the entire market, but or through a large enough sample that can actually, with a certain degree of confidence, let's say 95% confidence, be within a reasonable deviation. Usually look at the 1.5% either way, either side, and that's how it should be. Okay, so we have taken already too much time today. We exceeded our time by 7 minutes, which should not be the case. So we're going to stop here.